Most people spend 30 years building their retirement savings and almost zero time figuring out how to keep the IRS out of it. I've met with retirees who've saved $1.5 million or more and are losing $40,000 a year to completely avoidable taxes. Not because they did anything wrong, but because nobody told them that the decisions they make in the first 5 years of retirement about how and when you pull your money out will either cost you tens of thousands of dollars or save you just as much. There are 5 specific moves that smart retirees make to legally slash their tax bill. Most people know about none of them. In the next 15 minutes, I'm going to walk you through all 5. If you have money in a 401k, an IRA, or any pre-tax retirement account, this video is for you. Quick note before we get into it. If you want to sit down and map out your specific retirement tax strategy, there's a link in the description to book a free consultation with me. Take 30 seconds. Now let's get into this. Here's the first thing that I want you to understand. Most people assume their taxes go down in retirement, and for some people, in some years, that is true. But for a lot of retirees, especially those with significant savings, retirement taxes are actually higher than expected, sometimes significantly higher. Here's why. Your entire working life, you're in accumulation mode. Every financial decision, maxing out the 401k, deferring the income, letting it grow, is designed to delay taxes as long as possible. And that was the right strategy. But here's the thing nobody tells you. All that deferred tax doesn't disappear. It's waiting for you on the other side in retirement. When you hit age 73 or 75, the IRS requires you to start taking money out of your pre-tax accounts whether you want to or not. These are called required minimum distributions, or RMDs. And every dollar that comes out is taxed at ordinary income at your full marginal rate. If your balance has grown significantly, and I hope that it has, those RMDs can push you into higher tax brackets than you expected. They can trigger the 85% tax on your Social Security. They can cause your Medicare premiums to jump up by thousands with something called IRMAA. 3 separate tax hits from one account that you didn't even choose to touch. The good news is all of this is plannable if you start early enough, and that's exactly what we're going to talk about today. Now let's go through these 5 moves. Move 1, Roth conversions in your low income window. This is the most powerful tax strategy available to most retirees and the most underused. Here's the idea. The years between when you retire and your RMD begins at age 73 are often the lowest income years of your adult life. You're not working, Social Security may have not started yet, and your RMDs haven't kicked in. Your taxable income is usually low. That is your window, and it is the best time in your financial life to convert pre-tax IRA or 401k money into a Roth IRA. You pay the tax on the conversion at today's low rate. The money moves into a Roth and it grows completely tax-free forever. And when RMDs start at 73 or 75, your pre-tax balance is smaller, which means smaller forced distributions, lower tax brackets, and lower Medicare premiums. Every dollar you convert strategically during this window is a dollar that will never be taxed again. Move number 2, strategic withdrawal sequencing. Not all retirement accounts are taxed the same, and the order in which you pull money out of them has an enormous impact on your lifetime tax bill. The general framework in early years of retirement is to draw from your taxable brokerage accounts first. You've already paid the tax on those. Let your pre-tax accounts keep compounding. Then, in the middle of retirement, draw from pre-tax accounts in a controlled way, enough to fill the lower brackets, without pushing in the higher ones. Save your Roth for last, when you need flexibility or face a large expense with healthcare or long-term care planning. Most people just pull from whatever account is easiest. Strategic sequencing can save tens of thousands of dollars in taxes over a 20 to 30 year period. Move number 3, Social Security timing. When you claim Social Security, it isn't just a question of how much you get, it's a tax question too. Up to 85% of your Social Security benefit is taxable if your combined income, which is your adjusted gross income plus tax exempt interest plus half of your Social Security, exceeds $34,000 for a single filer or $44,000 for a married couple. For most people watching this video, you're going to be in this bracket. Here's the counterintuitive move many tax-savvy retirees make. Delay Social Security while doing Roth conversions in your low-income window. By delaying Social Security, you get a larger benefit later, and by keeping your income low during the delay years, you can do more Roth conversions without triggering Social Security tax or IRMAA surcharges. It's a coordinated strategy, and it works. Move number 4, Qualified Charitable Distributions, otherwise known as QCDs. If you're over 70 and a half, and you give to charity, this is one of the cleanest tax strategies in the entire tax code. A qualified charitable distribution, or QCD, lets you transfer money directly from your IRA to a qualified charity, up to $105,000 per person in 2026, without that money ever showing up as taxable income. Compare that to the alternative. You take the RMD as income, paying tax on it, and then you donate the after-tax amount. With a QCD, the entire distribution goes to charity and you pay zero tax on it. It also counts towards satisfying your RMD for the year. Keep in mind that you can do partial QCDs. It does not have to be the full amount. If charitable giving is part of your plan, this is the most tax-efficient way to do it. Move number 5, tax loss harvesting in your taxable accounts. If you have a taxable brokerage account with investments that have lost value, you can sell those positions to realize a capital loss, which directly offsets any capital gains you may have in the same year. In retirement, when you're managing withdrawals and potentially realizing gains from rebalancing, tax loss harvesting gives you a tool to offset those gains and keep your taxable income lower. Medicare premiums, less Social Security taxation, and potentially staying in a lower bracket entirely. It's not a home run strategy on its own, but combined with the others, it's a valuable part of the annual tax planning toolkit. Let me take a few minutes on Social Security because the tax piece here is one of the most misunderstood parts of retirement planning. With good reason, because it is confusing. A lot of people assume Social Security is tax-free income. It was originally, but Congress changed that in 1983, and now today, up to 85% of your Social Security benefit can be subject to federal income tax depending on your other income. Here's how the math works. The IRS looks at something called your combined income. That's your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. If that combined number exceeds $34,000 for a single filer or $44,000 for a married couple, up to 85% of your Social Security is taxable. For a lot of retirees, and frankly most of you watching this video, you have significant savings. This threshold is crossed almost automatically once RMDs begin, which means the RMD doesn't just create its own tax bill, it also pulls Social Security into the taxable column. This is called the tax torpedo, a sudden spike in effective marginal rates caused by the interaction between RMDs and Social Security taxation. The solution is planning ahead of it. Do your Roth conversions before RMDs start. Delay Social Security if it makes sense for your situation to keep income low during conversion years. And work with someone who can model the interaction between all of these pieces, because optimizing one in isolation often creates a problem somewhere else. I want to share a quick story that puts all of this together. Started with a client a couple of years ago, a retired school principal, 64 years old, husband, recently retired from a corporate career, combined pre-tax retirement savings about $1.4 million. No pension to speak of, Social Security not yet claimed, comfortable, but not an extravagant lifestyle. When we ran the projections without any planning, their RMDs at age 73 were going to come in around $95,000 a year. Combined with Social Security, that was going to push them into the 32% marginal bracket and trigger the next level of IRMAA surcharges, adding thousands to a year to Medicare premiums. So we built a 5-year Roth conversion plan, $55,000 a year converted per year during that window, staying within the 22% bracket every year. We delayed both of their Social Security claims to maximize the benefit, and we used their taxable brokerage account, which had some unrealized losses, to fund living expenses while the conversions happened. By the time RMD started at age 73, their pre-tax balance was about $900,000 instead of $1.4 million. Their annual RMDs were now $33,900 instead of the $95,000. And they stayed in the 22% marginal bracket. Their Social Security taxation was minimal, and their Medicare premiums never triggered the next level of IRMAA. Total lifetime tax savings compared to doing nothing, we estimate to be over $180,000 across a 25-year retirement. From 5 years of intentional planning during a window that most people don't even know exists. That's the kind of work that we do at Bluebell Wealth Management. If you're within 10 years of retirement, now is exactly the right time to have this conversation. The link to book a free consultation is in the description.